Alright, hi everyone. Welcome to today's webinar brought to you by IC Markets. Right, today is going to be the pre-market live analysis. I just want to make sure we are streaming on YouTube, and you can drop your requests or questions in the live chat box at any point during today's webinar. Alright, so I think we're good to go. Alright, okay, before we start, let's go through the disclaimer. Alright, please take note that this is marketing communication. It does not contain and should not be construed as containing investment advice or an investment recommendation or an offer of or solicitation for the transactions in financial instruments. Also, take note of the risk warning that comes with trading forex and CFDs. They carry a high level of risk to your capital, and you should only trade with money you can afford to lose. Right, so my name is Ketan Ramachandra. So this webinar series is brought to you in a special partnership between IC Markets and Everest Fortune Group, where we have been the finalists for Best FX and Equity Research for the following years, 2019, 2020 and 2021. Alright, so before we dive into the charts and trading view, let's take a quick look at the key economic events that are lined up for this week. Right, it's a pretty heavy calendar, as you can see on my screen here. Right, so we've got a few things going on. Today we've got German preliminary CPI data out of Germany today. We've also got retail sales out of Australia tomorrow, followed by PMI data out of China as well. That's going to be pretty key as well. We've also got we've got flash CPI estimates for headline CPI and core CPI for the Euro area tomorrow as well. And then on Wednesday, in the second half of the week, I would say we've got heavy employment data out of the US. Right, up first we have ADP non-farm payroll or non-farm employment change coming up on Wednesday at 12:15 p.m. GMT time, and at 2 p.m. GMT we've also got JOLTS job openings, as well as ISM manufacturing PMI data as well. Right, and not only that, we've also got the FOMC statement that's going to be released. Right, FOMC is going to run from 30th of May to 30th of April to 1st of May. Right, so the meeting concludes on 1st of May, where the press statement will be released, as well as Jerome Powell's press conference at 6:30 p.m. GMT time. So take note, it's going to be a pretty heavy second half of the week with regards to news events. Right, basically we've got ADP employment report, JOLTS job openings, ISM manufacturing PMI data, and followed by, of course, the FOMC meeting. And on Friday as well, we've got, of course, non-farm payrolls, as well as ISM services as well. So as you can see, a pretty heavy calendar for lined up this week. Hi, Ren. All right, sure. Definitely we'll cover the pound and Aussie as well. Yeah, we'll start off the analysis on the dollar index, of course, and then we'll make our way down through the majors, and of course we'll cover the pound and the Aussie as well. Alright, so before we dive into the charts and trading view, let's take a quick look at how the ADP employment report has been coming in over the last few months. As you can see, the first quarter of 2024, the trend has been higher. We've seen more jobs being added over the last few months, right? In the second half of 2023, you could see the job gains were relatively muted compared to the first half of 2023. However, there does seem to be a pickup in employment change for ADP in the first quarter of 2024. However, when we look at the forecast for April, it's a little bit lower, expected to come in at about 179,000, which is a little bit lower than the figure of 184,000 in March. So although the trend looks to be still in the right direction, however, it's just coming in at a little bit lower. Now, should we see the actual result come in higher than the forecast of 179,000, right, this is quite likely going to function as a potential bullish catalyst for the dollar, right? So that means, of course, dollar index is going to rise, and currency pairs like the euro, pound and Aussie are likely to fall as well, right? So if you look at the previous report by the ADP, right, so in March, this was the highest jump in hiring since July, right? As you can see, in July we had a figure of almost 310,000. So this was quite a pretty large increase based on relative terms, right? And also, not only when job gains were strong across a wide variety of industries. We can also see pay gains are starting to heat up as well, or could remain elevated as well. So pay is continuing to heat up for both goods and services sectors as well. So what this means is if pay is increasing, right, the US consumer should have relatively stronger consumer power, right, or spending power, right? They should have relatively higher spending power despite higher interest rates as well as elevated inflation as well. Right, when we look at Joel's job openings, right, they've actually been trending lower since the second quarter of 2023, right? So although jobs are still being added to the economy, right, as we see in ADP data and of course in the NFP data as well, however, hiring practices all seem to be tapering off, right? So number of job openings would reflect how aggressive companies are looking to hire. However, as you can see, it has been trending lower, but it's not that is not completely fallen off a cliff. But yeah, generally you can see hiring practice over the last 10 to 12 months have trended lower. Now, of course, should we see the result come in higher than the forecast of 8.68 million, once again, this could then potentially function as a bullish catalyst for the dollar. Conversely, right, if you see result where ADP comes in lower than the forecast and also job openings as well, lower than its forecast, respective forecast as well, then of course this is quite likely to create overhead pressure for the dollar. Right, and coming up to NFPs, right? So non-farm payrolls, we can see over the last 4 months, monthly job gains have been relatively strong, right? We can see employment gains remain elevated by historical standards, and also we saw, although February's result was revised lower to 270,000, and previously it was about I think I can't remember what it was, maybe about 280, but it was revised lower. But however, we can see that January's data was revised up. So there's been a bit of uh, mixed outcomes with regards to revisions. Some months they've been revised down, some months they've been revised up. But overall, you can see over the last 4 months, this has been a relatively strong labor market where jobs do seem to be continue to be added quite strongly on a monthly basis. And we can also see the unemployment rate is expected to remain at 3.8%. And although in February we saw it spike higher to about 3.9, this was a 2-year high with regards to the unemployment rate. However, despite tightening measures right by the Federal Reserve, we see that the unemployment rate has remained relatively stable between 3.7 to 3.9%, which of course suggests that the US labor market remains strong. So of course, if we see the actual result for April come in higher than the forecast of 243,000, while unemployment rate remains at 3.8%, or perhaps if it even edges lower, then of course this is very likely to create strong demand for the dollar, right? And should we see strong strong employment figures in the US, that's quite likely going to mean that the Federal Reserve is going to maintain rates at current level as well. The Fed funds rate currently sits at 5.25%. So given that the US labor market is still strong, inflation, as we've seen, has been persistent right over the last 3 months. When we look at headline CPI and core CPI as well as PPI data, right, it looks like it's starting to re-accelerate in the US. So inflation is persistent, employment or labor market is still extremely robust in the US. So that means the Fed is quite unlikely to cut rates anytime soon, right? So at this on 1st of May, right, Thursday, during the FOMC meeting, it's quite likely they're going to maintain their interest rates at current levels, and they may even switch to a more hawkish outlook as well, right? Although they may not raise rates anytime soon, but they may adopt a much more hawkish outlook, where previously in the last 2 to 3 meetings they were very neutral, and some would even say they were leaning on the side of being very dovish. And of course, all eyes will also be on Chairman Jerome Powell's press conference, which is definitely going to create a lot of volatility for markets as well. Alright, okay, with that, now let's dive into the charts on TradingView. Alright, hi Nick. Yeah, sure, with dollar index, of course. Alright, hi Jamilu, hi Philip. Right, of course, now that we're on TradingView, of course, we're going to start the analysis on the dollar index. Right, okay, so here I am on the daily time frame, right? So take note, as you can see here, that for at least in in 2024, the dollar index hit a high of 106.52, right? You can see right back in mid-April, dollar index hit a high of 106.52. However, since that date, over the last two to 3 weeks, it has been trending lower. It's a decent pullback. Of course, with such a strong rise in the dollar index in 2024, we can expect some healthy pullbacks along the way, which is what we saw since mid-April, right? And last week, especially on Friday, we saw PCE price index data being released as well, which once again showed inflation is indeed persistent and sticky in the US, which thus created strong demand for the dollar, right? So that's why we had this big jump last Friday as well. Right, so quite likely after finding decent support here at 105.57 last Thursday and Friday, right, this is going to be our first support here. First support for the dollar index is 105.57. And as well, when I run the Fibonacci retracement, right, I've run a Fibonacci retracement from here, from this low here on 9th of April, ending with the high here on 16th of April. We can see that the Fibonacci retracement at 38.2% aligns pretty well with the first support, right? So we're quite likely to see the dollar index resume its bullish momentum today, right? So the pivot point for today has been identified at 106.37. Take note, I'm still on the daily time frame, right? So it's quite likely the dollar index could once again push up towards this level here at 106.37 and potentially run into a little bit of resistance here, right? Also take note, we've also got a nice descending trend line, right? This descending trend line, we can see dollar index bouncing off this descending trend line several times, right? You can look at it here. This is a nice trend line as well. So we do see a strong support area that is bounded by the ascending trend line. This pullback support at 105.57, as well as the Fibonacci retracement at 38.2%. So we have three factors that are highlighting a very strong support area. So should we see dollar index rise higher towards the pivot, it may pull back once again. However, but that pullback is likely to be a good supporting area for price to resume the uptrend as well, right? And of course, when we look at the first major resistance for the dollar index, when we go back here to look at the market structure back in October and November of 2023, right, we can see a very significant swing high resistance take place, right? We can see a very significant swing high resistance take place. We can even say that this is a double top as well, right? We can see the dollar index hitting a high here on early October, and then making a second high here on the 1st of November before dropping lower. So you can see double top price action as well. That is marked overall by a very strong swing high resistance. Similarly, we can see here the market structure here in July of 2023, highlighting a very significant swing low market structure, as well as at the end of December of 2023 as well. Once again, market structure highlighting a very significant swing low support area here as well. So of course, with this being a multi-swing high resistance or double top or swing high resistance, that's where we're going to identify our first resistance for the dollar index here, right? So first resistance on the dollar index is at 107, right, which is the high of October and November 2023. We've got the pivot identified at 106.37. Quite likely the dollar index is going to continue to push higher, but of course it may potentially stall around this level here, pull back a little bit. As I mentioned here, we've got a strong support area that's bounded by the ascending trend line, the pullback support, and the 38.2% Fibonacci retracement, right? So we do see the dollar index rising higher as markets open, and we may see it pull back as well, right? Any pullback is likely to be supported around this area. And of course, since we've got employment data out of the US, right? So if we do see very robust employment data reported by the ADP as well as by the BLS for NFPs, right, that's quite likely going to create or going to function as another strong bullish catalyst for the dollar. So take note, we've got a very interesting week, right, with regards to news events, employment reports, as well as the FOMC meeting, which is definitely going to create or inject a lot of volatility into markets, especially in the second half of this week. All right, so these are the key levels for the dollar index, right? It's going to push higher towards the pivot, and any pullback here is likely going to be supported by the area that's bounded by the ascending trend line, first support, and the Fibonacci retracement at 38.2%. Alright, okay, now let's just make our way down the majors. Right, we've had requests for the pound and Aussie, so we'll just go on to euro, pound, and then we'll look at the Aussie as well. Alright, so of course, with the dollar index rebounding strongly on Friday, so of course the euro is likely to pull back as well, right? The euro pulled back quite strongly on Friday, so I do see a strong overlap resistance level here, right? Let me show you this here. We can see that this is a pretty strong overlap resistance level at 1.0737, right? We can see price has reacted off this level several times, right, running the resistance here on 6th of November, after which it found strong support here on early December of last year, once again finding support here on 5th of February. Of course, this bit here in mid-February, we see price dipping below this overlap level here. However, it did reverse to bounce higher, once again finding strong support here on 1st of April, and of course running into resistance last week as well. So you can see several times where the euro has reacted off this overlap very significantly, right, very strongly. So this suggests to me that this is a very significant overlap level, which is what we're going to use to identify as the pivot for this week, right? So we can see last Friday the euro has already reversed off this level here, and of course if you expect the dollar index to continue rising this week, the euro is likely to drift lower, and where that support could come in is this pullback support level here that's occurred on 16th and 17th of April, which is at 1.06, and of course the first major resistance for the euro is going to come in at 1.0859, right? This we can see is a pretty significant pullback resistance level here, right? We can see back in 8th of April, as the euro was retracing higher, it stalled around this region between 108.60 and 108.90 before reversing to drop lower. And not only that, we also see a pretty decent descending trend line, right? We can see that the euro has reacted off this descending trend line 3 times, right? We can see running into resistance on 13th of March, 21st of March, as well as on the 9th of April, right? We can see several times where the euro has stalled around this descending trend line and is reversed to drop lower, right? So of course, with the dollar index expected to push higher, right, we may see we are quite likely to see the euro drift lower as well. Alright, okay, so that's the euro. Then let's move on over to the pound. Right, let me see if there's any Ichimoku cloud as well. Right, okay, so of course you can see that the Ichimoku cloud here is, okay, this color is not very clear. Let me see if I can improve the color for the Ichimoku cloud. Yeah, this is a little bit better here. Okay, so when we pull up the Ichimoku cloud, we can see that the euro is also continues to trade underneath the Ichimoku cloud, highlighting the bearish momentum or the bearish trend. And we can see here that the cloud is currently in red as well, which does indicate strong bearish momentum, right? So we do have several factors that lead to an overall bearish outlook for the euro, right? We see it still trading underneath this descending trend line. You also see market structure is making a series of lower highs and lower lows, as well as the euro trading underneath the Ichimoku cloud, and with the cloud highlighting bearish momentum as well. All right, let's then move on over to the pound. All right, so similarly, when we look at the market structure for the pound as well, remember we're on the daily time frame. Since 11th of March, we can see this currency pair has been in this pretty strong downtrend, right? We can see a series of lower highs and a series of lower lows, right? It's quite clear. It's a very strong bearish momentum, and I would say there's probably a descending trend line that we can highlight here as well. right? You can see this descending trend line where the pound has run into resistance and around 14th of March, 21st of March, of course here as well, 9th of April, and we can even sort of argue last Friday price quite came close to this level once more before reversing to drop lower. So you can see quite clearly that the pound is still in a bearish downtrend, right? The market structure highlights a very strong bearish downtrend, as well as the currency pair itself trading underneath the Ichimoku cloud and with the cloud itself in red, highlighting the bearish momentum, right? Okay, so for this week, right, the pivot for the pound has been identified at 1.2574, right? Why is that the case here, right? We can see there is a pretty decent overlap level around here, right? I'm just going to highlight this level here. Previously, back on 1st of April, as the pound was falling back, it found strong support around this level here at 1.2570, right? Roughly around 1.2555, right? Retraced a little bit higher, bounced back again, and then when it broke underneath this level, it retraced a little bit. It attempted to retrace higher on the 11th of April, but it stalled once again before reversing to drop lower, right? So you can see here that this region here, it is actually a pretty strong overlap level here. And also if I were to extend this as well, you can see here that there was a pretty decent pullback support here on 15th of February as well, right? Pretty strong pullback support over here. So this zone here highlights to me a very significant overlap, which has been identified as the pivot, right? So there's a strong overlap resistance here that's bounded by several things. We have the descending trend line, right? Take note, don't forget about this descending trend line. We've got the overlap at 1.2574, and we also have a Fibonacci retracement, right? So we've run this retracement from here, right? Take note, we've started this retracement from here, this high on the 9th of April, and ending of course with the low on the 22nd, right? When we pull up the 61.8% Fibonacci retracement, we see that this retracement level aligns pretty well with the overlap resistance as well, right? So we have three factors that point to a very strong resistance zone, right? The descending trend line, the overlap at 1.2574, as well as the Fibonacci retracement at 61.8%. So of course, if dollar index is expected to push higher this week, then of course the pound is likely to resume its downward trend. But of course, price never moves down in a straight line, right? There can be retracements up, retracement to the upside as well. So that's quite likely going to stall around this resistance here that has been identified around the pivot. So remember, once again, the pound is also making a series of lower highs, series of lower lows, indicating the structure highlights a bearish momentum, and of course is trading underneath the bearish Ichimoku cloud as well. Alright, okay, so these are the key levels for the pound. Of course, the first support for the pound is 1.2328. Of course, we see price making a very significant swing low bounce off this level here on last week, right? 23rd and 24th of April as well, right? So there's a very significant swing low here, swing low support over here. Right, strong swing low support at about 1.2300. Okay, then we've also had a request for the Aussie, right? Pound, Aussie, Euro, the dollar index. Yeah, we count down. Okay, so let's look at the Aussie as well. Okay. Okay, when you look at the market structure for the Aussie, right, in since February, right, basically when we look here, since 14th of February till 12th of April, right, so for a period of 2 months, you can see there's no real major bullish uptrend or downtrend for the Aussie. You can see it was actually pretty much ranging approximately between 64.80 and about 66.30, right? So roughly it was trading sideways, so we're experiencing sideways range bound price action for this currency pair. However, in mid-April onwards, we saw strong demand for the dollar, so of course that means the Aussie experienced a very sharp pullback over this week and a half, right, dropping as low as 63.64 before finding strong support here on 19th of April, right? This is a very strong support zone for the Aussie as well, right? So you can see over the last uh, trading week, right, over the last, let's say, a week and a half, or 7 days, 6 to 7 trading days, we saw a very strong rebound in the Aussie as well, right? So with that, it's approaching a key resistance level, right? This has been identified where the pivot is. The pivot is at 65.50. This level here has been identified as a strong overlap as well. Previously, you can see back on, let me just remove the cloud for a little bit for now, right? So you can see here back on 5th and 8th April, we saw the Aussie pull back a little bit here, finding support at around 65.50 before bouncing higher. Then of course, as it reversed sharply, we can see here on 11th and 12th of April, the Aussie did try to retrace a little bit higher but ran into resistance around this zone once again before reversing to drop lower. Similarly, last Friday, the Aussie hit 65.50 again, running into resistance at this overlap here as well. So it's quite likely, we can see here quite clearly that this is a pretty strong resistance zone for the Aussie, and we also have a Fibonacci retracement lined up at this level here as well. So you can see here this retracement, we started this retracement from here, this pullback that occurred on 9th of April, ending with a swing low here on the 19th of April. We can see that the 61.8% Fibonacci retracement. Let me see if I can adjust the labeling so it's a little bit more clearer. Right, so you can see that 61.8% Fibonacci retracement aligns very well with the overlap that was identified at 65.50. Right, so creating or helping us to identify a significant resistance zone for the Aussie, which is where the pivot has been identified. So it's quite likely we could see the Aussie stall around this level once again and reverse to drop lower. Where it could find support is this overlap level here at 64.42. Right, okay, this is not the cleanest level here, but you can see that this is a strong swing low support that occurred on 13th of February. And when you look at the market structure for the Aussie over this period, right, you can see this is a very significant swing low support that occurred in mid-February. And even if I pull it all the way back, you can see there's a pretty decent pullback support here that occurred on 16th and 17th of November as well. So right, 64.42 does look like to be a pretty strong support level, but of course we can see price cutting through it here on the 15th and 23rd of April, of course, but generally you can see this is a level where the Aussie could once again find pretty decent support. Right, so should we see the Aussie reverse off the pivot here and continue to drop lower, it's quite likely going to find support around 64.42, which is also a level that aligns well with the Fibonacci retracement at 61.8%. So we started this retracement from here, right, this swing low here on the 19th of April, and ending with the high of last Friday. So once again, we can see another 61.8% Fibonacci retracement aligned very well with the first support. And of course, first resistance for the Aussie is at 66.28. Right, we can see the Aussie has run into strong resistance around this level since the 8th of March. Oh, hang on, where's my brush? Here we go. Right, we can see running to strong resistance from 8th of March till 14th of March. Stalling here as well on 21st of March, and of course last on 9th and 10th of April as well. So you can see several times the Aussie has run into strong resistance at 66.30, which is where the first resistance has been identified. All right. Okay. Hi Charles. Okay, could you look at Kiwi Canadian dollar? Yeah, sure. We'll look at Kiwi Canadian dollar as well. Definitely take a look at that. All right, great to see the request coming in. So we'll cover that. Then we'll probably take a look at dollar yen as well, since we had the BOJ meeting last Friday, right? Remember, the BOJ announced its monetary policy statement where they kept its key policy rate on hold. They kept it at 0.1%, and we saw the yen weakened very significantly, right? So dollar yen spiked last Friday along with all the yen crosses as well. So we'll cover that after we take a look at Kiwi Cat. Okay, let me see, do I have it saved here? Okay, no worries, let's go look it up. Right, okay, here we go. So okay, so I'm on a daily time frame for the New Zealand dollar, Canadian dollars, or Kiwi cat. All right, let's zoom out a little bit and see how this currency pair has been trading. All right, this is something that I don't look at often, but it's always interesting for me uh, to come across and perform the analysis on different currency pairs as well. All right, so as you can see here, pretty much I would say the Kiwi cat has been in a strong, relatively strong bearish momentum here since 22nd of February. Right, we can see a series of lower highs and a series of lower lows. Right, of course, there have been strong retracements to the upside as well, but generally I see a very strong descending trend line, right, that has taken place since the end of February. Right, this is a pretty strong descending trend line. Right, we can see, of course, price this currency pair running to strong resistance here in middle of March, as well as running to strong resistance once again in mid-April as well. So this clearly highlights a very strong resistance area for this currency pair. Right, if we look at the Ichimoku cloud as well, right, we can see that the currency pair is also trading underneath the Ichimoku cloud itself, and the cloud has turned red over here, which highlights the bearish momentum for this currency pair as well. Right, okay, I believe we can also run and before that, of course, I also see a strong support area here as well. Right, you can see price pretty much making market structure showing us a strong like double bottom here. Right, we can see this currency pair bouncing very strongly off 880.80 on 1st of April, and once again on 19th and 22nd of April as well. Right, this is like a double bottom that has been formed here, and of course price is being capped by this descending trend line as well. Right, there's a strong resistance area that's bounded by the descending trend line as well. Right, so this would be a pretty I would identify 80.78 as my first major support for this currency pair Kiwi cat. I believe I can also use a Fibonacci retracement from here. We'll start from this swing low here on 23rd of October, going up to the high, which is the high, is it here, 84.156. Okay, so this is the high here on 29th of December. Is there a 78.6% Fibonacci retracement that we could use? Okay, it's around that region, not exactly. Let's just keep it on for now. Right, so we can do see pretty strong support area over here. Right, and of course first resistance for this currency pair is going to be this swing high that took place, that has taken place here on 9th of April. This is quite clearly the first resistance here. Now for the pivot, right, as you can see here, there's the descending trend line that has restricted any retracements to the upside, and of course when I look across this level over here, there's another pretty decent uh, overlap level that's being formed here. Right, we can see price making a very significant swing low bounce of 81.57 back on 5th of February. Right, this is a very strong swing low support, and as price was falling very strongly towards the end of March, it once again stalled around this region again, highlighting the strength of the support. But of course it broke underneath it, but now you can see what was previously support has sort of functioned as resistance as well. Right, we can see on 17th and 18th of April this currency pair was retracing higher, but it stalled around this level again, and of course last Thursday as well on 25th of April it touched this level again and proceeded to pull back once more. So you can see quite clearly this is indeed a very significant level. Right, that is why I've identified this overlap as the pivot at 81.57, which is quite likely where the Kiwi cat could once again stall around this region. Take note, there are several factors that highlight a very strong resistance zone here. We've got the descending trend line, we've also got the bearish Ichimoku cloud, we've got this overlap resistance at 81.57 as well. Right, so we've got three factors that point to a pretty significant resistance zone. Right, so quite likely we're going to see right? Quite likely we're going to see the Kiwi cat retrace higher into this resistance zone and potentially stall around this level to reverse to resume the downtrend, right? I believe there's also a Fibonacci retracement that I can run from here. This swing higher on the 21st of February going down to this swing low here on the 1st of March. Is there a 50 or 38 and 50? I believe one of them. Right, okay, there is a 50% Fibonacci retracement that aligns very well with the swing high resistance that occurred on 10th of April. So let's just keep 50%. Right, okay, so these are the key levels for the Kiwi cat on the daily time frame, right? We can see market structure highlighting a pretty strong bearish downtrend. We see a series of lower highs, a series of lower lows. We also see that this currency pair continues to trade underneath the bearish Ichimoku cloud. The cloud is red in color. It is also trading underneath this descending trend line, and we can also see that this overlap resistance at 81.57 has offered pretty decent support, has functioned as pretty decent resistance since mid-April as well. And of course we see strong support here, this double bottom support at 80.78 that took place on the 1st of April as well as 19th April. Alright, hey Nick, thanks for thanks for encouraging the team to smash the button as well. Alright, yeah, do get in all the likes as well, really appreciate it. Alright, okay, so let's go on to dollar yen. Right, as I mentioned, we had the Bank of Japan announce its monetary policy statement last Friday, where they kept its key policy rate on hold, right, and that weakened the yen significantly. Right, we can see the yen opened at around 155 to 55 last Friday, dropping, pulling back slightly to about 155 before going as high as, let's see what was last Friday's high. Right, last Friday's high was about 158.43. Right, you can see this is last Friday's high as well. Right, so the yen has weakened significantly in 2024. So if the yen is weakening, then of course currency pairs like the dollar yen is going to rise strongly. And if we look at the yen crosses as well, we are likely to see similar price action as well. So we can see that price is also making a series of higher lows, higher highs, as well as trading above the bullish Ichimoku cloud as well, which highlights the strong bullish momentum for this currency pair. Now, it's quite likely the dollar yen is going to continue to rise higher, but of course there can be strong resistance levels as well, as we can see here. Right, previously we can see here over a period of 10 trading days or so, right, from 20th of March till the 9th of April, so about a period of 2 to 3 weeks, right, we saw the dollar yen pretty much do nothing over this period, right. It was just trading in a very tight range between 151 and 152, just a 100 pip range over a period of 2 to 3 weeks before finally breaking higher. So basically it's just consolidating around this area here before finally breaking higher as well. Similarly, we see that similar price action take place on the 13th of Feb till the 5th of March. So once again, another period of 2 to 3 weeks where the dollar yen was consolidating around 149.80 and about 150.80 as well, right? Another 100 pip range, pretty much doing nothing on the longer term, slightly on the medium term time frame before pulling back and finally going higher, right? So you can see here, perhaps once again we're going to approach a consolidation area for the dollar yen. Why is this pivot important? Right, this pivot is important. For that to appreciate this pivot, we're going to have to go onto the monthly time frame, right? You can see here the dollar yen is actually trading at about 30-year highs, right? So when I adjust the chart, we can see the last time the dollar yen was trading around 156, 157 was back in 1990, March of 1990. So basically the dollar yen is trading at 34-year highs. It's not at the all-time high, of course, but it's trading to a 30-year high, right? So this is a very significant level here. So we can see back then this was a very significant swing. This was a very significant swing high resistance that occurred in April and March of 1990, right? So this is a very significant level here, which is where the pivot has been identified. So potentially we could see the dollar yen stall around this level here, right? You could potentially stall around this level here, so that's where the pivot has been identified, and we could see price this currency pair pull back a little bit from this pivot here. And of course, with regards to the first major resistance, right, we have to go back once again to November of 1986, right? Once again here, when we look at the market structure here, as the dollar yen was falling sharply in the mid 80s, right, it retraced a little bit higher for a period of a couple of months before resuming the downtrend once again. So this little pullback resistance here is what we're using to identify the first resistance for the dollar yen, right? So now let's come back to where this currency pair is currently trading and switch back down to the daily time frame. So now we can truly appreciate the strength of this pivot here, right? This is a swing high resistance, a 34 years swing high resistance for the dollar yen. So it's quite likely we could see the dollar yen stall around this level here, right, bounded by last Friday's high and the pivot, right? This is a pretty strong resistance area, so we may see dollar yen stall around this region here, maybe consolidate as what we saw back in end of March as well as at the end of February. We may be running into a situation where we may see the dollar yen consolidate around this level at about 158.40. However, take note, any pullbacks for this currency pair is likely to be supported at around 154.77. This is a pretty decent support level as well. We can see previously this is another period of or area of consolidation for the dollar yen, right, consolidating around 154.80 since 15th of April till 25th of April, so about a period of a week and a half, right, 5 to 7 trading days before finally breaking higher. Right, okay, so these are the key levels for the dollar yen, right? First support at 154.77, which is pullback support level over here. Pivot is at 159.10, which is that swing high resistance, the 34 high swing high resistance, and first resistance is at 163.73, which is the pullback resistance that occurred in the mid 80s. And of course, the pivot is also, we also have a Fibonacci extension, right? To find Fibonacci extensions, we use the retracement tool. So right, we start the retracement from here, 13th of November, going down to this swing low here on the 28th of December. Remember, the key extension levels lie at 127 and 161%. So previously, you can see back on 16th of April till the 25th of April, roughly, the dollar yen was restricted by the extension at 127%, right? It remained under this level for a period of 5 to 7 trading days before finally breaking higher. So similarly, we do see that 30-year swing high resistance aligned very well with the Fibonacci extension at 161%, right? So let's get rid of 127. We don't need that anymore. But similarly, we do see that swing high resistance aligned very well with the extension at 161%, which does seem to suggest a pretty strong resistance area, right? So we may see dollar yen quite likely stall around this region as well, probably consolidate around 158.40, 159, right? Roughly around a 50 pip range, maybe consolidate around here for a period of few days. However, if we do see a pullback, it's quite likely going to be supported at around 154.77. All right, okay, now right, okay, so we've covered the currencies. Let's move on over to the commodities, right? Okay, we still got a little bit of time, so do let me know if there's any requests for any other instruments that you'd like to see, right? This could be the indices, the commodities, or any other forex pair as well. If not, let's just move on over to gold, right? Let's see how gold is trading as well. Similarly, when we look at the market structure for gold, of course, we can see a series of higher highs, series of higher lows, and of course, this commodity or this precious metal is trading above the Ichimoku cloud, which is green in color as well, which highlights the strong bearish momentum. Now, of course, similarly, when we look at the prices for gold on the monthly time frame, very clearly it's trading at the all-time highs, or it just made a new all-time high earlier in the month, right? So you can see quite clearly the last 2 to 3 months, or rather since the beginning of January, gold has been in a strong bullish uptrend. Actually, since making this pullback support level at the end of October here, gold prices have rebounded very strongly here. Right, previously this was a strong resistance level at about 2,000 and $30 per ounce. Right, this was a multi-swing high resistance in the past, which has now been, of course, been clearly been taken out. So it's a very strong bullish move for gold prices here. Now, of course, with regards to the first resistance, right, first we're going to take the all-time high at $2,431 per ounce as the all-time high, as the first resistance. So quite clearly that's where the first resistance is. And also when we look at on the daily time frame, generally we see gold has been restricted below $2,390 per ounce. Of course, we do have the wicks protruding above this level. However, when you look at the body of the daily candle, it has failed to close above 2,391, which has been used to identify as our pivot. So we could see gold prices rebound higher this week, right? It found pretty decent support on Wednesday and Thursday at around $2,315 per ounce, and it is quite likely could potentially retrace higher as well. So this is a pretty decent resistance zone. Where the pivot has been highlighted, we see a strong pullback resistance at $2,391 per ounce, as well as a Fibonacci retracement as well. Right, so we started this retracement here from the all-time high on 12th of April, ending with the low on 23rd. We can see that the retracement at 61.8% aligns pretty close to where this pullback at 2,391 has been identified. So highlighting a pretty decent resistance area for gold, right? And of course the pullback has been identified here as well at 2,315. Right, is there a Fibonacci retracement that I could use? Let me see, let's try one out. 14th of Feb going up to all-time high. Is there a 23%? Let's just pull up all the fibs. All right, okay, we can see that gold has already moved underneath the 23.6% Fibonacci retracement. So of course that's no longer valid, so that's fine. Let's not keep any retracements if they are not there. So we don't need any retracements for this part of the move here. So all right, okay, so this is what we have for gold, right? Yes, Nick, yes, usually gold and the dollar index have a negative correlation. So that means if dollar index is going to rise higher, quite likely usually gold is going to fall. And of course, if gold has been rising strongly since, as you see here, end of March till 19th April, usually over that same period dollar index should be falling as well. But there are periods in time where you can have positive correlation as well. So what I'm going to do now, I'm going to pull up, I'm going to do a comparison here. Let's compare it with the dollar index. So generally it has a negative correlation. So that means when the orange line, which is the value of the dollar index, when the dollar index is rising, gold prices are falling. So when dollar index is falling, gold prices are rising. Similarly, usually this inverse correlation or negative relationship holds true throughout most of time. But however, there are times when this negative correlation can break down as well. Wait, let me see if I can adjust this a little bit better. Wait, which one should I use? Same scale. Yeah, okay, maybe this is a little bit more easier to appreciate. Right, so as you can see here, orange line is the dollar index. When it was rising strongly from August 2023 to October 2023, gold prices were sort of consolidated before dropping lower. Then as dollar index fell from about 106.60 all the way down to 101, generally you could see gold prices moving higher as well. So this is the negative correlation that I was highlighting. But however, you can see generally it can exhibit positive correlation as well. So you can see here in April there has been relatively strong positive correlation. That means dollar index is rising and gold prices are rising as well. And similarly here towards the end of April, third week as well, dollar index was pulling back a little bit, and so were gold prices. So as you can see here, the previous negative correlation has now turned into positive correlation. So even though dollar index is expected to rise today or this week, it's quite likely gold could also follow suit as well. So take note of that. right? Usually, yes, dollar index and gold prices have an inverse relationship or negative correlation. However, when we look at the current degree of correlation, that negative correlation has sort of weakened significantly, and it's exhibiting a more stronger positive correlation between the dollar and gold prices. So please take note of that. All right, okay. So these are the key levels for gold. All right, let's just cover oil, right? We still got a little bit of time, so let's just cover oil as well. Right, generally when I look at the market structure for XTI USD, so this instrument tracks the WTI crude oil futures. We do see a series of higher highs and higher lows in 2024, right? So you can see here, generally the market structure is still the bias for the market structure is still to the upside, and we can also see this commodity trading above the green Ichimoku cloud, which highlights the strong bullish momentum as well. But of course, in any bullish trend, there are bound to be pullbacks along the way. Now, we saw crude prices find decent support at around $82.60 per barrel on last week, right? It pulled back 2 weeks ago. Crude prices pulled back quite strongly, but last week it did seem to find pretty strong support at around 81.60 and $82.60 per barrel, right? A strong support zone here. That's also has a Fibonacci retracement. So we started this retracement here from this swing low on the 5th of February, going up to the high here on the 5th of April. We see that 38.2% Fibonacci retracement aligns pretty well with this pullback support level here that's occurred on 22nd of March as well, and also lies slightly below this pullback support on last Monday and Tuesday as well. So right, this is a key support area that's bounded by the pullback at 82.43, the Fibonacci retracement at 38.2%, as well as the bullish Ichimoku cloud. Remember, the cloud itself can help us identify areas of support as well. The bullish Ichimoku cloud can help us identify areas of support. Now, with regards to the pivot point, pivot has been identified at the 61.8% Fibonacci retracement. So this retracement started from here. This high on 5th of April, going down to the low on Monday 22nd of April. We can see that this level here at $85.57 per barrel previously functioned as pretty decent support for crude oil for WTI from 8th of April till the 15th. So for over a period of 5 trading days, this was a pretty decent pullback support level, which of course now has been broken, which is where price could once again stall around this level here. Right, so take note, pivot point for WTI oil has been identified at this pullback resistance at $85.50 per barrel, which also aligns very well with the 61.8% Fibonacci retracement. First resistance, of course, is this pullback resistance that occurred earlier in April, which is at $87.13 per barrel. Now, when I look at this price action here now, I also see a pretty decent descending trend line, right? We see a pretty decent descending trend line here as well, right? So should we see so we have another factor that's highlighting a pretty decent near-term resistance for crude oil prices. So we may see WTI oil pull back a little bit, find support around this region before reversing to climb higher. Now, should crude oil perhaps in the second half of the week break above this descending trend line and the pivot, then of course it's quite likely going to resume the bullish momentum and make a run towards the first resistance. Remember, geopolitical tensions in the Middle East still run high, and any further escalation in this region is likely to cause crude prices to spike higher as well. All right, so take note, these are the key levels for WTI oil on the daily time frame. Right, okay, so before all right, welcome Nick. Yeah, so it's quite a useful thing to do as well. So if you have any currency pair with a dollar index or commodity and you want to compare their relative performance and try and identify if there's any, or try and visually identify if there's any inverse correlation or positive correlation, simply just click on the plus icon here, or which is the compare icon, then type in the symbol that you want. We want the dollar index, and select it as a new price scale, right? You can also select it as a percentage scale, but it's easier to visualize it on the new price scale as well, right? So clearly able to identify the relationship, right? So let's go back again to gold daily time frame. Let's go compare dollar index, new price scale. Right, you can see quite clearly, we can appreciate the inverse correlationship. Now if I go over to the monthly time frame, right, we can see this relationship is pretty clear, right? Remember, orange line is dollar index. So when dollar index was falling sharply May of 2010 down to May of 2011, so over a period of 1 year, dollar index was falling, gold prices were rising sharply. Similarly, as gold prices as dollar index started to rise from September 2011 till December 2015. Similarly, we can see gold prices top out at about $1,800 per ounce and resume a downtrend as well. So you can see this inverse relationship has held steady throughout time, but of course there are periods where this relationship can break down, and what we do currently see is a positive correlation between the dollar index and gold prices. So take note of that. Correlations can break down in certain periods in time or in certain market conditions, which is what is currently happening now. All right, okay. If okay, let me just get rid of this. All right. Okay, so if there's no further questions or any requests for any other currency pairs, then let's just wrap up the session by going back to the calendar as well. As I mentioned, it's a pretty heavy calendar this week, right? There's several things lined up. We've got CPI data out of Germany today. We've also got PMI data out of China, flash CPI data out of the Euro. We've got, and in the second half of the week, it's all about US employment as well as the FOMC meeting, right? The FOMC meeting is going to start on 30th of April and it concludes on 1st of May. And that's when the Fed will release its press statement at 6 p.m. GMT time, followed by Chairman Jerome Powell's press conference at 6:30 p.m. Remember, inflation in the US has sort of re-accelerated. When we look at CPI data and PPI data over the last 3 months, inflation is persistent. It's not trending lower as sharply as it was in the previous months. So that means we could see a switch in the tone of the messaging by the Federal Reserve, right? Although they're definitely not going to raise rates, they're going to keep their Fed interest rate at 5.25 to 5.5%. That's quite clear. They're definitely not going to raise interest rates, and they're definitely not going to cut either. However, they may adopt a pretty hawkish tone. So that means the statement and the press conference could see a lot of jawboning by by Chairman Jerome Powell to potentially push the dollar higher as well. And of course, if that's combined with stronger ADP employment report as well as non-farm payrolls on Wednesday and Friday respectively, that's going to once again function as a strong bullish catalyst for the dollar as well. So take note, it's going to be a very volatile period for the dollar and other currencies in the second half of this week. All right. So that's the end of today's session, right? Thanks everyone for tuning in today. Do look out for all upcoming webinars for IC markets for the rest of this week. And before we end, let's just go through the end disclaimer. Quickly go through the end disclaimer. Right, please take note that trading forex and CFDs carry a high level of risk to your capital, and you should only trade with money you can afford to lose. All right. So just keep an eye out for unemployment rate, non-farm payrolls on Friday. They drop at 12:30 p.m. GMT time. Forecast for NFPs is 243,000. We can see the last 4 months relatively strong job growth, and should we see non-farm come in higher than 243,000 while the unemployment rate remains unchanged at 3.8% or perhaps even coming in lower at 3.7%, this potential data set result is quite likely to function as a bullish catalyst for the dollar, right? And also take note of ADP as well and JOLTS job openings. Should we see ADP data report figure of higher than 179,000 and we see JOLTS job openings come in higher than 8.6 million again, this is once again another potential bullish catalyst for the dollar. Alright, so thanks everyone for tuning in to today's webinar. Do look out for all upcoming webinars by IC Markets for the rest of this week. I wish you all the best in your trading journey and catch you all in the next webinar. Alright, thanks everyone, take care and have a great trading week.